Like, good. As everyone sort of became more adept at parsing financial data, as the crisis unfolded, IRS Forms 990 and audited financials and so on, it became increasingly clear that what we needed was a more contextually analytical toolkit, less oriented around hard data and more oriented around what that data means in terms of tactics and strategies, and a kind of holistic understanding of the university as a site of production. And to that end, the sort of the groups that we just got out of are really crucial. And so it's been really pleasing to see university workers sort of think strategically along those lines. I've been maintaining it, as you saw in the introduction or in the email. I'll be circulating a bibliography based on kind of where this conversation goes at the end of this. But in the spirit of trying to deprofessionalize the teach-in, I'm going to kind of I've prepared a bunch of slides, I've prepared some fragments of pre-prepared texts, but the last portion of this is definitely meant to be a conversation. And if you feel like hopping in at any point, I guess you could message Brett or message me. So try to. So these are the three sections that we're trying to cover today. The first is perpetuity and accumulation. How Harvard Rules was a modest pamphlet issued immodestly. In this, it was a product of its 1969 occasion. Its headline, an impertinent sortie of signifiers, How, Harvard, and Rules, its subtitled method, an exhaustive materialism from above, being a total critique of Harvard University, including new liberated documents, government research, the educational process exposed, strike posters, and a free power chart. Produced pseudonymously, this self-published tract could be had for 25 cents on its cover price of $1, as the campus paper reported. It soon prompted a feminist follow-up, How Harvard Rules Women, arrived in 1970. And this will to exposition and demystification is, of course, broadly consistent with materialist research and the critique of institutions that emerged during the student movements of the 1960s. For example, Lexi found this example from Columbia, and there was also an internationalist bent to all of this, though we can't really get into that here, obviously. How Harvard Rules is peppered with charming aperçus from the private university's history of fiscal self-lubrication. Quote, educate and save ourselves and our families and our money from mobs, unquote, a Harvard benefactor is remarked to have written in an 1886 solicitation of funds. One section on corporate power and the power of the corporation described the university's industriousness internally as an educator of the children of the bourgeoisie and a producer of same, as well as externally. Harvard, the reader is informed, was a participant with the Massachusetts Institute of Technology in the development of the Route 128 electronics complex, which is, of course, to this day an arterial corridor of the region's techie industries. That academic industrial complex is further illustrated by a map entitled R&D, Research and Destroy. The financial spirit of the endowment is only fully broached in another subsection titled How Harvard Invests, dedicated to the university's then $1 billion endowment. Excerpted from another source, a 1968 trade publication, it describes a primordial form of the self-dealing which is today the overbearing rule at the Ivy League accumulation. For the treasurer of the Harvard Corporation was also the president of the State Street Investment Corporation. You can see that in one of the tentacles in the image on the right, which in turn managed assets for Harvard. That this rentier's rentier was a self-dealer was not the only problem. The moral hazards of investment delivered treble damages, as in the cases of Middle South Utilities, a clammed-up Southern energy concern from whom Harvard undergraduates had demanded divestment, or apartheid South African business. When the treasurer was confronted by students regarding the unsavory former matter, he told them, quote, our purpose is just to invest in places that are selfishly good for Harvard. We do not use our money for social purposes, unquote. The present Harvard president, Larry Bacow, recently formulated the COVIDian update to the frank amorality of his 60s predecessors. Calling back to the historical idiom of the perpetual trust and the more recent neo-Keynesian work of the economist James Tobin on intergenerational equity, he has rebuffed calls to tap the endowment to avoid institutional austerity by invoking, quote, a moral responsibility to those who will come after us, unquote, calling upon his constituents to, quote, act decisively and selflessly to preserve all that makes the university special, unquote. The historical transfiguration of selfishly to selflessly is the sordid interval between the institutional spirit, perhaps, of '69 and 2020. That drama, though, between these constituents of Harvard's two bodies, the undergraduates of the college against the treasurer of the university, or Universitas, the corporation, turns out to be an historical role play of sorts, and not just because it's an act that has traveled into our present. The concept of endowment scrambles at least two historical logics at the university, namely charitable foundation and perpetual incorporation. Today, the foundations of elite universities, managed as they are by a retinue of subcontracted bounty hunters, i.e. private investors, and dispersed by university administrators with seeming hair triggers set for austerity, might appear just another vector of what has been generously dubbed disaster capitalism. But we should consider endowment also within the privative basis of universitas as such, rather than indulge in the innumerate dragging of administrative salaries, which amount in the end to a very small portion of the profits, if we can call them that are generated out of the ordinary functioning of the university, though that's hardly to exonerate them. A new pamphlet on the functioning of the American university could simply read, How Endowments Rule. And the real question it would have to answer is, how is this different from the rule of capital in the general economy? As a collective called Research and Destroy concluded in a communique issued from the 2009 occupation of UC Santa Cruz, which was helpfully pointed out to me by Mia at Yale. And more broadly, how do we balance between celeritas and gravitas, historicization as fetish or an active historicity? And I guess these are questions we have to ask with an eye to a longer haul struggle where we probably don't want to exhaust ourselves with details or murder militancy with nuance. The Yale investor David Swensen's 2000 trade tome, Pioneering Portfolio Management, an Unconventional Approach to Institutional Investment, might be the nearest stand-in. Far from being a how-to manual for untoward canoodling, I guess, between the endowment and hedge funds, Swensen's book pillories the rent-seeking private investment industry. The book was premised on his success in swelling Yale's hoard by means of judiciously placed investments with independent private equity and hedge funds beginning in the middle 1980s, including one fund, Farallon Capital, run by a young Yale alumnus named Tom Steyer, last seen spending $200 million on a vanity presidential campaign. That was the image with which we began. Pioneering portfolio management is littered with warnings about inefficient and unscrupulous investment managers that the endowment must strenuously avoid if they are not to be swindled by exorbitant fees and paltry returns. A more apposite title might be Haranguing Portfolio Managers. It is no surprise that Swensen and his successor, Charles Ellis, seem to have spent a considerable amount of time lately telling anyone who wishes to follow in their footsteps not to bother trying, because for every Yale, there are a dozen Cooper unions, where mismanagement craters an endowment rather than growing it. So, what is a perpetual institution, and what is a charitable institution? The nonprofit category does not meaningfully distinguish between, let's say, a charitable organization like the Carnegie Corporation or the Gates Foundation, which is meant to spend down an accumulation, and Yale or the Museum of Modern Art, both of which basically want to exist forever. Or in the immortal words of the neo-Keynesian economist James Tobin, quote, the trustees of an endowed institution are the guardians of the future against the claims of the present. In formal terms, the trustees are supposed to have a zero subjective rate of time preference, unquote. So to make sense of all of this and to make sense of this kind of like impossibly long duration, we need to set the university against its basis, which is just another way of saying its material social factors of production. And in the contemporary US, this has required developing a benchmark concept called HEPI, or I don't know if it's abbreviated to HEPI, but it could be. The higher education price index, and that sort of explains why tuition continually outpaces inflation. And the explanation that David Swensen gives in his book is what you're seeing on your screen, that basically lack of productivity gains in education mean that as time goes on, education becomes more inflationary, costs more than the general economy. As the economy becomes more efficient, i.e. productive, education remains the same. Bodies and rooms become ever more relatively expensive to maintain, to really simplify things. But this is the first moment where, in establishing a kind of foundational idea to the logic of all universities, one begins to realize that education sort of has to be subsidized in the kind of world we have chosen, the economy that the large economy we have chosen. The nature of that subsidy, its piecemeal, incredibly lopsided meritocratic logic, has grown absurd. And this sort of subtends any discussion of endowment. But what this amounts to is that if you have to maintain your institution in perpetuity, you become extremely sensitive to long-term trends and the cost of the activity you need to subsidize. And basically, higher education is inflationary at the level of labor in principle, which is what these people claim. And this is basically the crux on the cost side of why endowments are so riskily invested yet conservatively spent, because you need to beat the market and avoid being correlated with it in order to continue doing what you do. This is kind of an area where I think more investigation and more critique could be directed. And there is a vast literature on this. And it's not entirely the case that this inflationary index, which is maintained by a kind of lobbying front for the university administrator lobby, that this has been challenged, including by Bruce Kimball, who has a great article on the revenue theory of cost, which is kind of like flips the argument and says that universities just spend everything that they can get. But let's try to first to kind of get to the nuts and bolts of how endowments have actually shifted from a kind of passive return that is generated out of yield, which occurred in the middle 1960s, where there was a decisive transition from endowment spending from yield only, like bond payments, to spending overall appreciation of their portfolio. And this was made possible by sort of changes in the culture of investment, the changes in the ability of university endowments to tap instruments like debt. But this is kind of the decisive moment that affects where endowments are invested today and how endowments are invested today. Did not really begin with David Swensen. It begins earlier, and he talks about this in his book around the middle 60s, where the norm started shifting away from, you just have an endowment that you spend, you buy a bunch of bonds and you get, coupons on those bonds, and you get debt payments on those bonds. You buy, let's say, a debt that is owned by General Electric or General Motors, and they pay you sort of a sum that's decided in advance, and that's the only thing you spend, to behaving more like investment firms, the investment firms that they exist as today. Okay, so the second and ultimately really the last section of this teach-in is on investment and reproduction. So trying to unpack the implications of what we've kind of laid out in terms of how the university operates. Not so much at the level of little charts of like what's invested where, but in sort of the ethos behind it. So this passage from one of Princeton's annual reports I found to be very helpful, because it had the three concepts that are really essential to trying to understand kind of the logic of the endowment and the logic of administration that accompanies it. Total return, a consistently applied formula, an obsession with rules in general, in setting budgets, and the idea of management fees, which is something that we'll return to momentarily. So Princeton, like its peer institutions, runs its on-the-ground operation like a 19th century company town, extracting profit from the provision of food and shelter to a captive audience of students and faculty. It mints its own scrip in the form of dining plan points. It directly deducts rents from its tenants' paychecks. Meanwhile, Princeton, also like its peer institutions, claims to run its endowment at the cutting edge of 21st century finance capital, which is to say it is a soup kitchen for private investment managers from whom it consistently accepts subpar returns while paying hundreds of millions of dollars in performance and management fees for the privilege every year. The management and performance fees paid by endowments to private investment managers, as occasionally appears in the press, as has occasionally appeared in the press, pauperizes any administrator paycheck that can be sleuthed out of an Internal Revenue Service filing. Though the amounts vary by fund type, this fee structure is commonly referred to as 2 and 20. 2% of the total amount invested and 20% of the profits, if any, generated by the investment are to be paid every year by the depositor to the investor. For a sense of scale, if a university allocates $10 billion of its endowment to actively manage funds, it pays out $200 million every year in management fees alone, or $1 billion every 5 years. If that $10 billion returns 10%, an average result in the last decade, closing the year at a net value of $11 billion, they pay an additional $200 million, 20% of that uptick to the manager. Such fees differ considerably between investors and types of investment, but it would not be an overstatement to say that investment managers have paid tens of billions of dollars, that investment managers have been paid tens of billions of dollars by the top handful of private university endowments in the past decade. So what does this mean in practice? So looking here at a table from a recent Yale treasurer's report, you kind of have obfuscatory terms applied to each category of investment or each asset class, absolute return being the most nebulous. But basically all that matters, and the reason, and I think it's very important to kind of avoid getting super bogged down in these distinctions, because what matters is how much of this is managed by the endowment proper and how much of it is subcontracted out. And virtually all of it is subcontracted out. And the concept in the private sector for what an endowment is often called a fund of funds, which is basically an investor, a meta investor, or something like a family office, where like a family fortune is invested not so much by the people who work in that office, but by people who are employed by various investment companies that are employed indirectly, essentially. So, like all decadent empires, the rule of endowments is indirect. The endowment offices of private universities have for nearly a half century operated as funds of funds. They do not themselves directly invest the entirety of their capital, but rather hire various kinds of private investors to do it for them. This arrangement also shelters the fees paid out to those independent managers from public scrutiny. While the salaries of chief endowment officers and various people who work in endowment offices, if they're part of the main university body, are publicly disclosed on IRS forms, where they often exceed those of the president, fees paid to outside investors are absorbed into the performance metrics of the endowment and scarcely mentioned in private universities' various disclosures and reports, the quotation of which we began as one exception. What I'm showing now is a kind of an important moment where in 2016, after sort of a rash of criticism, and this happens periodically every few years, where it's sort of discovered that universities are tax exempt, but they also make so much money for private equity and hedge funds and so on. Everyone gets really mad, and then they have to respond, and their response was net performance matters, which is effectively it doesn't matter how much money we're paying. We're getting a tax. We're tax exempt. We can pay people to make us money as long as they make us more money than we could have made otherwise, which is an interesting idea. But then you have to deal with the uncomfortable sort of analysis of whether or not these active forms of investment generate more returns than simply investing in index funds. And there's been a lot of like Local 33 and a lot of various uh, sort of campus groups in recent weeks have kind of done this analysis. But I think what's missing from all of this is a kind of understanding of the more integrated social system that's at play here. Because every few years, the press does remember the broad facts we've laid out, and endowment officers hurriedly beat their exculpatory horse. We have to invest in hedge funds and private equity rather than a simple stock market index, they say, because those actively managed funds, while riskier, offer returns that are not as correlated to larger market movements, decoupling us from excessive worry about financial cycles of boom and bust, thereby fulfilling the most fundamental purpose of having such a hoard, which is to be insulated from economic shocks. Then, when the markets are shocked, as they were in 2008, and again under COVID-19, this argument is hastily forgotten. Endowment managers become gnomic, and university administrators bring out the other old horse, austerity. Surprise, though, it's the same horse. And this apparent incompetence or confusion is at bottom good donor relations. What appears to be a blatant disregard for responsible low-risk stewardship of its endowment has in fact been a future-oriented kickback strategy. Princeton and various Ivy League institutions, or private institutions in general, I should say, and some public ones, pay out hundreds of millions in fees to asset managers who inevitably underperform much cheaper options, like simply investing in an index like the S&P 500, as a subsidy to its past, present, and future class of donors. While the implications are harder to unravel, this is evidenced by an historical trend that has been unfolding since the 1980s, at least, across private universities. From 1989 to 2014, private equity and hedge fund managers went from occupying 4 to 32% of Board of Trustees officer positions, while the share of board offices held by all kinds of financiers, including the investment bankers who earn a living by providing services to private investors, went from a minority of 32% in '89 to a majority of 67% in 2014. Such a blatant kickback scheme can operate with impunity as it does not consist of one-for-one quid pro quo. We pay you to manage a chunk of our endowment, you donate money to us, another subject that the press has recently seemed to learn a lot about. The kickback functions at a greater level of abstraction, with the overall effect of cultivating the same minuscule global plutocracy of private investors that are the elite university's current and future fiscal constituency of parents and donors. These donors may object to the kickback theory by indignantly explaining that they have given more to alma mater than their funds have raked in, but that is an obfuscation of their systemic effect. When Ivy League universities invest in active managers, they become both an incredibly valuable marketing tool for the specific managers they have selected, such that one hedge fund managers can raise many multiples of a commitment from Yale by invoking their participation to other more important, if risk-averse clients in other sectors, like trillion-dollar pension funds, which is literally what happened with Tom Sire, as well as a crucial industry-wide legitimation of the very idea of what has been called the endowment model of active investment, often attributed to David Swensen. So the chronic investment underperformance that this scheme produces is then covered up in annual reports with a practice we can call benchmark shopping, in which, for instance, Princeton, like the rest of its peer institutions, blatantly cherry picks market level investment data in order to lead the largely financially illiterate readers of those reports to believe that the endowment is performing in line with or greater than expectations, when in fact truly comparable data largely indicate that Princeton's investment strategy has cost its endowment billions of dollars in management and performance fees, as well as investment opportunity costs in the last decade. So what this all means is that when thinking about the use of active management, it's very important to think about the actual accumulation. And Swensen's book is full of these charts, and the bibliography that I'll send out will have more of this as well, if you need to see it. But it's kind of obvious where if you simply play ball with this kind of model of investing, you plug into a system of social extraction that is absolutely the basis of private universities and the way that Yale exists as it does, or Harvard exists as it does, or Princeton exists as it does. So that's the big issue, and I feel like that's something that has been missing in the conversation about this subject. People are just sort of complain that, oh, Yale pays all this money out, or Princeton pays all this money out, but there's no real understanding of why it actually makes sense or what it's really meant to do. Um, so other sources of profit that I've sort of seen at Princeton and that are endemic to higher education, and I won't really spend too much time on this because it's already been covered in various contexts, but this company town rubric of room and board, and then patents and intellectual property, which I won't get into at all. But an example from Princeton is that a lot of the graduate housing, both current and future, is subcontracted to an organization called American Campus Communities, which is a publicly traded $6 billion real estate company that manages 100,000 beds nationwide at a profit of 15%. I think a gross profit of 15%. And so this was an area where, you know, we could kind of look up who Princeton was working with, and very simply kind of figure out what they do in this case because they're publicly traded. And then there's the case of dining services, also very well known site of subcontracting. When I was an undergrad, there was this sort of leak that someone discovered from LinkedIn where the director of dining services was bragging about how the Dartmouth Dining Services made 1.3 million in net income in the 2010-2011 fiscal year, despite the economic recession. And I think that this is sort of the kind of thing where if you develop like a sort of independent model as a kind of activist or as an antagonist of the institution, mapping these things out is very useful in trying to figure out and actually potentially actionable against the institution given its nonprofit status. This is Farallon Capital Management, which was again in its early, very early days when Yale's investment sort of turned it around. So this sort of concludes the general thrust of my comments. I have I wanted to end with an artwork since I am an art historian, that basically that sort of summarizes the kind of term, a key term for us, which is disgorgement. And in 2016, Cameron Rowland had the alternative artist space in New York buy $10,000 of shares in Aetna as a reparations purpose trust. And with the idea that in the event that federal financial reparations for slavery are paid, the trust will terminate and its shares will be liquidated and granted to the federal agency charged with distributions. And I think what's interesting about this is that it sort of puts into the frame of the art institution, or kind of makes ambiguous who benefits from the staging of claims of disgorging surplus, sordid surplus, or sort of ill-gained accumulations. Do we want a more fair university or a more fair society? And these things are obviously not zero sum. There's this, just this week, there's been sort of a legal threat to the Whitney Museum's nonprofit status from the right. And again, if you go back to this moment here with the Wall Street Journal about the congressional Republicans discussing taxing endowments in 2016, there's a kind of culture war box that can be opened as well in the kind of critique of universities that I think should be discussed a little bit more. But on that note, I wanted to kind of open things up to discussion and questions.
I think Ellen had put herself on stack. Maybe, Mustafa, if you want to stop sharing your screen. Ellen, are you still there?
Yeah, I am still here. Thank you very much. That was really interesting. I've been spending some time in a lot of tax returns in 990s, and you've given me a bunch of guideposts to look for as I go through that. So this is a pretty specific question, but there are some universities that don't seem obligated to publish, or that ProPublica doesn't find the 990s for. Bucknell's not one of them, which is where I am. But the toolkit, I haven't looked at it yet. I presume it includes some alternative ways, like the ones you've described, to go around the limits of the 990.
Yeah, so thank you. Yeah, so there's different ways to do this. Universities will like have to disclose to donors what their sort of audited financials are, or they generally circulate those to donors. So those can be something you can find through the university itself. There's also freedom of information adjacent requests that you could make, or simply writing the university. By law, a nonprofit has to make a Form 990 available to inspection. So if it's not online, then you can just write them.
Okay, thank you. I also have a question about a structure that I wasn't familiar with, and I don't know if you are, but I was looking at the University of Richmond's financials, and they have something called the Spider Investment Fund, which has bumped their endowment to over $2 billion in very short order. I don't understand. It seems like a completely different approach. Do you have any knowledge or understanding? It's one of our peer schools that we always compare to, and so I don't know how to put that one in context.
I don't know about Spider management, but I can take a look at it and we can talk offline.
I'm not giving you homework. I'm sorry.
Okay.
I just thought.
No, it sounds super interesting. Yeah, no,
it's really weird, and they have totally different filing status than the University of Richmond itself. Thanks. This was incredibly useful. Thank you so much.
Thank you.
Anyone else? I have a question if no one else does. Oh, there we go. Mia, please.
Yeah, thank you for this, Mustafa. This was great. And I agree with your point about what's sort of been missing from these conversations that the various endowment justice groups have been doing on campuses. And I guess I wanted to ask, from putting this presentation together, what is your sense of the points where we have some leverage? You mentioned like all of the different vendors that operate on campus, but were there other places where you feel like we can be focusing our research or attention to plan escalation?
Yeah, so there are a couple things. The first is that may I share my screen again? Is that possible? Am I allowed?
Yes, you are.
Okay, thank you. So there's like close reading Forms 990 is useful to a certain degree, and also a huge waste of time to a large degree. But one issue that I had sort of started working on a long time ago and abandoned is this issue called offshore blockers, which is how most endowments, this is an image from a Guggenheim Museum 990, basically end up having large portions of their endowments held offshore through the funds that they invest in, the managed funds that they invest in. And this was sort of vaguely touched on in the Yale endowment presentation. But if you kind of go through the 990s and look at who holds what, you can figure two things out. One, where are these things held? Yale or whatever is, banking offshore. This is an issue where there's been statutory, like sort of regulatory interest. That's sort of a longer term thing. A more short term thing is, who are the trustees who have potentially, gained from the investments of the endowment? And second, along the lines of disgorgement, what are the biggest private investors that each institutional endowment is associated with. For example, how much has Yale paid to Tom Steyer over the years? And to straight up hit up Tom Steyer and say, you know, you should give some of this back. But the thing is, once you ask for that disgorgement of historical fees, you know, it's just going to go to Yale. And I mean, it's neither, it's sort of, I don't know about the actual, you know, how that shakes out, but I think thinking about these sort of mechanics of investment can generate useful pieces of information and potentially interesting tactics, but it can also just be frustrating. Perhaps alternative institutions should be created.
Thank you. Vera had a question. Vera, we can't hear you. Are you there?
Okay, there we go. Sorry, I couldn't find lots of stuff going on the screen. So I find this very useful. At the same time, I find it very frustrating because and I was commenting this in the earlier sort of strategy group as well, which is that there are two directions that I think one can take this type of analysis, and they're not incompatible, but neither are they equivalent. And what I mean by that is that we could develop a lot of detail analysis and sort of exposés of the abuses, if you want to define them that way, of the ways that the endowment has been used, managed, and who has profited, and so on and so forth. And sort of work on the purification of the functioning of the endowment. We could do that. The problem is that purification seems to me a little bit utopian in the context of the fact of what it is. It is a series of capitalist investments, so how could they be cleansed? And the other, but the other level that takes me to is the sort of broader political issue, which I discussed in the previous group as well, which is, why do we even have these endowments? What is their source, and are they legitimate? Because in reality, and you and I have discussed this, Mostafa, in a different context, and but the origin of these endowments are fortunes that were created through the accumulation of capital from stolen wages that then were donated with appropriate tax exemptions and so on and so forth. Then you have the tax-exempt status of the institutions that possess them, which basically means that they get to operate and also profit without paying any kind of taxes whatsoever, while at the same time being subsidized by the working class yet one more time, a second round of subsidy by the working class, which is subject to regressive taxation and therefore contribute the bulk of the public monies that go into public education, but also into private education. And lastly, you get all of these whining about the money that higher education doesn't get, and all of these fucking, I'm sorry, I'm very upset with this, so I'm sorry for the language, but all of these stimulus bills and aids that are now being passed in Congress by all of these crocodile tear, hand-wringing people to assist education. Again, a third wave of subsidy from the working class to these endowments of institutions that then turn around and exclude the vast majority of the working class from opportunities to education by making entry to education expensive and restrictive. So I question the very validity of the existence of these institutions with those endowments from the very get-go. To me, they shouldn't exist. They should be nationalized. And that, to me, So that's what I mean by these two different types of politics. One is a politics that seeks to correct the malfunctionings, if you wish, and the ills of the handling of the morality of the endowment, while preserving its character, what it actually is. And the other one is more radical. It addresses what this thing is and how it allows for a system of education that does not cater to the population, that is an impediment to the free and open education for everybody. I think they should be nationalized, and that money should go into the vast expansion of public systems at the community and state level. That would then also provide all the jobs that we are now worried about that are not there for recent PhDs and master students coming out, and also BAs and BSs coming out of the college systems. So I think that this kind of information that Mustafa put together, I think it's key to understanding the mechanics of this and who exactly is who in the university, so that we can have specific tactics within. But if we're talking about building a broader movement against austerity and a broader push for a different kind of education and educational system, just like we're talking about public medical systems, then the conclusions should be different. And the analysis is different, which isn't just how they function, but how do they originate and exist, and how we permit that to happen, and who benefits and who doesn't in society. So I wonder if that might be also something we could discuss at some point, which is, what is the bigger political aim of this group, besides or in addition to all of the specific strategies that you all want to develop within your specific universities or across universities and so on and so forth. That's all I have to say.
Thank you. Yeah, no, I mean, I guess I agree. And that was precisely the subtext of like, I mean, not just the subtext, the literal text of much of this, which is that, you know, the question, do you want a fairly distributed endowment, a marginally more quote unquote fairly distributed endowment, or do you want to talk about disgorgement? And when you talk about disgorgement, that implicates a whole set of structural questions that you know, need to be worked out. I think that it's easy to kind of give up, and I think that there's a kind of also a form of quietism in, you know, shifting to the social immediately, even though it requires a suspension of disbelief. You know, like it is kind of a bad faith move to like try to make Princeton more fair to grad students. You know, I don't disagree with that.
It ain't happening.
I know. Well, it's not going to happen either, but it could. Yeah, and I think also you highlighted a second point, which is which I didn't really sort of hammer out in what I said earlier, but that it would be helpful to stop thinking like the media, and this idea, this sort of expository, like, oh my God, like the endowment, it's like, you know, it's so many hedge funds, and like, oh, administrators are paid so much. I think it's more useful to have a systematic sense of how things work and to put pressure on those things. You know, we all understand what's happened to the public sphere. We all understand that like the media doesn't really sort of work in the way that we think it works. And yet, like all, you know, campus activists pursue the same playbook from the 60s, basically unalloyed, where they think if you just pull the cover back, everything will be fine. But, you know, that's not going to occur either. So the stuff about the historical material was meant to kind of point that out also.
Other questions? We've gone a little bit over time. It seems like there's, I mean, that's quite a question at the end there, which I think is a really valuable one. That I mean, it's not only aimed at you, Mustafa, but I think also at like this group. Like, what is it that we're doing? And I think that there's, you know, maybe some value to picking up on that conversation in the next meeting, unfortunately, because of our time frame. Unless there are any other questions, or Mustafa, you wanted to add anything else at the end here?
No, thank you. I will sort of finish that up with an eye to what was just discussed, and I'll circulate it to you by email, and then you can send it out to everyone here, or those who are interested can write. I don't know. We'll figure something out.
Yes, we will absolutely make that toolkit available. Thank you so much for putting it together. There's such a real treasure chest of information here that goes very deep and very detailed, while also I think aiming at those bigger questions that Veda brings to the fore as well. We will make that available to everyone, and it'll clearly be available on the back end. All right, so I'm going to just stop your sharing and just thank everyone for sticking with us to the very end here. Thanks once again to Mustafa, and thanks to those of you who participated in the conversation. Check back early and often. We will continue our discussion about strategies, and I imagine that the so-called transparency working group will have a lot to chew on between then and now. So without further ado, happy Friday, everyone. Get some rest.
Thank you. Thanks, everyone.